Information provided by Wall Street Petting Zoo is for educational purposes only and not intended to be financial advice. Please consult with a licensed financial advisor before making any financial decisions.
It was a bloody week on Wall Street this week amid uncertainty around rising coronavirus cases and a contentious US presidential election. Hello and welcome back to the Wall Street Petting Zoo. This is our This Week at the Zoo segment in which we review the previous week's market news and look ahead to the coming week. I'm Christopher Smith.
And I'm Robert Coburn. The stock market took a brutal dive this week, with S&P 500 closing down over 5.5%. The sell-off was driven by a combination of election uncertainty and fear of renewed economic shutdowns amid rising coronavirus cases around the world. Economic data and earnings from the big technology firms this week were pretty good, but that was offset by the bad news. Amid a dramatic spike in new coronavirus cases in Europe, Spain, France, Italy, the UK, and Germany have either announced or are considering new lockdown measures to control the spread. The new lockdown sparked riots in Spain and Italy that ended with a number of people injured or arrested. Meanwhile, the US may face renewed unrest as well if elections results are contested, or at least so warned Facebook CEO Mark Zuckerberg on Facebook earnings reports this week. Walmart is also expecting unrest and remove guns and ammo from store shelves in anticipation of post-election looting of their stores. And then there's the political uncertainty: who will win the election and how might a Biden or Trump win affect the economy. We don't have all the answers for you, but we do plan to tackle the question of the likely election results and how it might affect the stock market. We have a special election episode for you this week.
That's right. This week we are interviewing Michael B. Wang. Michael is a full-time trader with an academic background in economics and a professional background in finance. And he is trying to produce educational content for traders over on TradingView, where he is Michael_Wang_official. And he can also be found on Twitter at Michael_B_Wang. Michael wrote a great article over on TradingView, which you can find if under the editor's picks section, about trading the election. And we've invited him on to talk about his findings in that article and to see what he can tell us about how the election might affect stock markets. Michael, why don't you summarize for us, just to start us off here, your findings in that article?
All right. So first of all, Christopher and Robert, thanks for having me. What I wrote about in this article on TradingView was essentially how things would play out depending on whether Biden gets elected or Trump gets elected, and whether the stock market would actually be affected by either one of these candidates getting elected. So what I did was I looked through a lot of studies and papers, and I found some interesting data where it took the market's price movement, the stock market's price movement from 1924 to 2017, and it demonstrated data of market returns where they compared a newly elected Democrat and a re-elected Republican. So this demonstrates that basically when a newly elected Democrat is elected, people generally tend to sell in fear that they're going to promote some sort of economic policy that's more oriented towards equality. So whereas when a Republican gets reelected, people tend to actually prefer that news and think of it as consider it bullish, right? But overall, if you look at it over the long term, there's really no difference in terms of the market returns you get, whether it's a newly elected Democrat or a re-elected Republican, right? So one of the main messages that I wanted to portray here is that what a lot of people are trying to do with the elections and basically in the market, what you see a lot of traders do is try to predict the market. They try to predict price actions. They try to predict outcomes of important news that might heavily affect the market. But fact of the matter is, predicting the future is extremely difficult. And even if you predict it correctly, it's most likely because you were lucky with it, right? So what I like to do is think of everything in terms of probabilities. So what I did here is essentially I just came up with a very general scenario for when what might happen to the stock market when Trump is reelected and when Biden's elected. So in this case, when Trump is reelected, my assumption was that the stock market is going to continue upwards with extreme momentum. And when Biden's elected, the stock market continues to correct for the short term, but then it's going to go up over the long term. And what you want to do is allocate probabilities for each of these scenarios and then prepare accordingly, as opposed to trying to predict who's going to win and then literally just betting all of your portfolio on that one decision or that one probable case.
Yeah, I totally agree that
Yeah.
probabilistic thinking is the way to go. And unfortunately, a lot of people are not very good at that sort of probabilistic thinking, are they?
Right, right. Our brains are wired to gamble in a way, so people don't approach it from a very neutral stance where they say, "All right, let me see what my risk reward ratio is here. Let me see what are the probable cases or the probable outcomes of what might happen and the probabilities of each of these scenarios." They just say, "All right, my gut feeling says Biden's going to win, so that's what I'm going to go with."
Right. So
Yeah.
we've got election models. The statistical election models right now are putting a Biden victory at about a 90% probability. Those are
Hmm.
from Real Clear Politics and The Economist. But we also
Hmm.
have political betting markets that have Biden at about 65%,
Right.
which is more like a 2 in 3 chance of winning. What do you think might account for that difference? Are betting markets mispriced, or are they taking into account some piece of information that the statistical models can't take into account? And is there potentially a profit opportunity betting on Biden in those political betting markets?
So that's the thing. I haven't looked clearly into the variables exactly that they're taking into account when they're um, uh, factoring the probabilities of winning. But but I just try not to rely on such speculative results. For instance, the 538 is a website that came up with the 2016 election forecast, and it said Hillary was going to win by a landslide. She had a 72% chance of winning, and they used like three different artificial intelligence models, gathering up all sorts of data, factoring in all sorts of variables as they could, and the results turned out not to be true, right? So again, we never know what's going to happen. Right now, yes, if you think of it from a probabilistic perspective, Biden has a higher chance of winning, but you can never say that Trump's not going to win, or you can never say that Biden's going to win for sure. Secondly, in terms of the spread that exists between the election models and the betting markets, I'm not too sure what individuals are thinking when they're betting, but I do think there is some opportunity in the betting market where you could possibly hedge your position by betting on Biden winning, for instance. Um, so in my scenario, I said if Biden gets elected, we might see a temporary correction for the short term. So if you could put some money on Biden potentially winning, that could be a hedge for your position.
Right. So have some money in the stock market that would profit from a Trump victory, but have some money in the political betting markets that would bring you some profit in the case of a Biden victory. So that way you have some protection in the event of a Biden victory. That's what you're saying.
Exactly.
Yeah, so I think, a couple things. I think that the election models in 2016 did give Hillary about a 70% chance of winning, but that still means that 30% of the chance Trump is going to win in that scenario. So, I mean, it is within the probabilities. And also, I think that basically what happened there is that they assume in those models that the undecideds are going to split about 50-50 between the candidates. And what ended up happening was, as a result of the last minute Comey announcement in 2016, the undecideds split about 9-1 for Trump in the last days before the election.
Mhm.
We do have, in this case, I think, the possibility that the mail slowdowns and things like that might affect voting and lead to some miscounting of election results or something like that. So maybe the markets are pricing in stuff like that. But I also think that people's willingness to pay for sort of political identity signaling is pretty high, and so there may be some mispricing happening in those the political betting markets.
Most definitely, yeah.
Let me ask you this. Does it matter if Democrats gain control of the Senate as well as the presidency? Because as you pointed out, markets tend to
Mhm.
react negatively to a Democratic win, but then in the first year after a Democratic win, generally markets come back up as they realize that sort of the Democratic policies either aren't going to be as fully realized as the president wants them to be, or aren't going to be as bad for markets as they have been sort of expected to be. But in the case of like a Democratic landslide, a Democratic sweep where Democrats gain control of the whole government, that presumably would give them more freedom to really implement the policies that they want to implement without having to compromise with the Republicans at all. So I'm wondering if that, in your opinion, does that change the outlook for markets from a Democratic victory here?
Right. So again, I did another post about this actually called "The End of Tech Stocks: Facebook, Amazon, Apple, and Google." And what I basically did here is review a 450-page long report by the House of Representatives. And what they were essentially trying to do is they were calling out on these four companies for violating the antitrust law. And I was really thinking about what could potentially happen to these companies, and I don't think there's much they could do for several reasons. One of which is in America's competition against China right now in terms of tech, dismantling these major tech companies is almost suicidal at this point. That's not what they want to do. Secondly, these tech companies that they're trying to dismantle is that these companies are actually very democratic friendly, like Facebook, for instance. Um, so while there is reason to think that Democrats gaining control of the entire government might be bad for the market, realistically, I don't think there's much that they're going to actually do. There's also studies about how policies get watered down compared to when candidates actually first claim what they're going to do. So they say they're going to do one thing, but eventually, once they get to power, they realize not everything is so easy as they expected. Procedures are extremely bureaucratic, and their policies eventually tend to get watered down. But at the same time, I do think there is some bad news for the market because there's a study that says every 10-point increase in capital gains tax decreases the S&P's multiple by 2 to 5. So then eventually we could see some sort of multiple compression or margin compression over the years. And what this could lead to essentially in, I think, 2021 or 2022 is maybe companies reporting higher earnings, but then seeing stock prices fall as a result of higher taxes imposed on these companies and on capital gains tax. So, and for the short term, what we might also see is people who are holding long-term positions eventually want to pay 23% in taxes as opposed to 43%. So once Biden does get elected, I think we might see a huge sell volume, which is why I thought that for the short term, we might have the probable case for Biden's election was that we might see a steep correction in the market for the short term.
Yeah, I mean, there's the corporate tax hike as well as another factor, which I've seen analyses of that suggest that it will sort of disproportionately impact the big tech. And given that big tech is trading at much higher multiples right now, I think there's certainly
Mhm.
room for a correction there. It seems to me, um, even not taking into account the antitrust legislation. Um, are you allocating your money differently in the event of a Biden victory? Are you potentially going to reshuffle your allocation in your portfolio in terms of like what sectors you're invested in?
Right. So me personally, I've been heavily invested in tech for 3 years. I personally have done performed greatly with growth stocks. And what I'm personally doing right now is I'm holding a significant amount of cash without having sold any of my positions. And what I'm looking to do is either sell some of my holding positions when Trump gets elected, and as I expect the market to overheat at some point. Um, and when technicals sort of indicate that the market's overheated, there's too much money flowing in, the multiples are at, you know, these are absurd multiples. That's when I'm going to sell part of my holdings right now. But if Biden gets elected, I'm most likely going to be buying the dip. So For now, my current position is simply to hold. I don't think this is the best place to buy or sell. There's a lot of volatility here. There's a lot of fear and uncertainty in the market, as you said in the intro. So, me personally, that's what I'm doing.
Okay. Let me ask you one last question, which is it possible that who is president matters less than where we are in the 4-year cycle? I'm thinking specifically of Jeffrey Hirsch's election cycle theory. Have you looked at that at all?
Yes, I did.
Yeah, so
Yeah.
basically what Hirsch
Mhm.
suggests is that there's like a 4-year cycle that presidents at like in the first 2 years of their terms are not as interested in sort of goosing the stock market because they don't have an upcoming election. But the closer you get to the election, the more sort of urgent it becomes for them to goose the economy and goose the stock market. And so in the third year of their term, um, they tend to have a really, really strong stock market performance, like on the order of 2 or 3 times better than any other year of the 4-year cycle. And it's in the
Mhm.
like the second year of their term that you tend to see really big corrections.
Right.
Um, what do you think of that theory? Do you have an opinion on that?
Yeah, so I do think it's a very valid opinion. It's from a political approach, right?
Hmm.
And I've read about another study where it basically says the same thing, but from a different approach, where it literally takes into account just the data and takes a financial perspective of things. And what it says was Democrat presidents tended to report higher excess returns from the market compared to Republican presidents. And the conclusion of the study was that this was solely based on timing, right? So when the market tended to be bullish, that's when we had Democratic presidents, as opposed to Republican presidents who were elected in uh, times where the market was less favorable to their interests. So essentially, we have two different pieces of evidence supporting the same idea. I think it's a matter of timing. It's also a matter of political decisions these lawmakers and the president makes, depending on their point and period of the term.
Yeah, and that would make a lot of sense. In times of prosperity, then you can start thinking about the distribution of wealth. You can elect somebody who is going to help spread the wealth around a little bit more like a Democrat. Whereas in
Mm-hmm.
times of, really weak economy, weak stock market, then you might want to elect somebody who's really growth oriented like a Republican president. So it makes sense that Democratic presidents would come in, times of prosperity like that. I also have seen that, in an election year, when a Democrat is going to get elected, the markets often will sort of discount the stock market leading up to the election. And so maybe Democrats are coming in with sort of a low bar, and it's easy for them to clear that bar then and get those excess returns, and the market corrects back up once it realizes that sort of the Democratic president isn't going to be as horrible for the stock market as expected.
Right, right, definitely.
Well, thank you so much, Michael, for talking with us. I think it was very educational, very informative. Again, anybody who wants to find Michael on Twitter can find him at Michael_B_Wang. And on TradingView, he is Michael_Wang_official. Michael, anything that you want to say before we sign off here?
Just a word of advice I want to give you guys is just always to be humble in the market because you can never predict things. All right. I've seen so many people get wrecked, literally lose their entire life savings because they were making bets on based on their predictions. No one can predict the market. Warren Buffett doesn't make a lot of money because he predicts these things. All right. People need to get they need to be prepared for the future. The future is not something you need to predict. That's
That's
it.
great advice. I mean,
All
lots
right.
of basic investing principles include things like diversification and buying protection and,
Mhm.
never making too large a bet on any one thing because the most important thing you can do as an investor is preserve your capital because you want to survive to be able to place bets another day.
Absolutely. Yeah.
Well, thank you so much, Michael. And
Well, thanks for
if
having me. Yeah.
Absolutely, absolutely. If our
Yeah.
listeners heard anything on the podcast today that was useful to them, please give us a like, share, or comment. You can find us on Podbean and on YouTube. Share us out on your social media accounts. And give Michael a boost too. Click on his TradingView article and share that out on your social media accounts as well. And we will see you back at the zoo next week.
See ya.